Horizon Aircraft, ticker symbol HOVR, missed consensus on the bottom line for Q4 fiscal 2026. Revenue came in at exactly $0. EPS printed a net loss of 77 cents a share, bringing their total net loss to $33.096 million for the year. On the guidance and liquidity front, management claims their $78.3 million in cash provides over 24 months of runway, but shares still took a slight dip of about 3% on the open.
Which, isn't totally shocking for a pre-revenue aerospace print, but it definitely sets a specific tone.
Right, it definitely does. So for you listening, our mission for this deep dive is to figure out what this actually means for your portfolio. We need to unpack exactly how a pre-revenue eVTOL company, that's electric vertical takeoff and landing, is burning through that capital. We'll evaluate management's roadmap to commercialization, and most importantly, we are going to dissect the hidden risks buried deep inside the fine print of their 10K filing.
Yeah, because the lens you have to use here is, well, it's completely different than evaluating a mature cash-flowing company. I mean, when you're analyzing an early-stage aerospace startup, the income statement isn't a scorecard of past successes.
It's more like a survival countdown clock.
Exactly. It's a strict timeline of future survival. Every single dollar flowing out the door is it's a calculation of how long they can keep the hangar lights on before they either hit a commercial milestone or have to go begging to the equity markets.
So we established that $33 million net loss. The immediate analytical question you have to ask is, where is that capital actually going?
Right. Let's look at the expense profile.
Yeah, so looking at the lines, the research and development expenses just skyrocketed. We were talking about a jump from $3.66 million in fiscal 2025 all the way up to $13.244 million in fiscal 2026.
While general and administrative stayed pretty flat.
Right. Yep. G&A held relatively steady at $10.224 million compared to $9.925 million the prior year. So the vast majority of this fresh capital is flowing directly into building their full-scale technical demonstrator aircraft, the Cavorite X7. Okay, let's unpack this.
Let's do it.
When I see an R&D jump of that magnitude, I immediately compare it to a rocket on a launch pad. I mean, it is burning a massive, almost alarming amount of fuel before the payload even leaves the ground. But I have to push back here.
Go for it.
Is this a sign of efficient capital deployment for hardware development, or are we just looking at the beginning of an endless aerospace money pit?
I mean, it's a fair question, but I would argue that in this specific developmental window, a flat or declining R&D spend would actually be the massive red flag.
Wait, really? Why is that?
Because the jump is just a mechanical requirement of the transition they're making. Think about the timeline. Back in 2025, they finished flight testing on a half-scale prototype, right?
Right, the drone.
Exactly. That was purely validation. You're talking about a drone with a 22-foot wingspan weighing, what, roughly 600 pounds? Its only job was to prove the basic aerodynamic physics of their fan-in-wing design.
But scaling up changes the math.
Oh, completely. The physics of scaling are brutal. You move from a 600-pound drone to a full-scale passenger aircraft that needs to carry 1,500 pounds of useful payload, hit forward speeds of 250 miles per hour, and safely transport a pilot plus 6 passengers.
That's a massive leap in material stress.
Yeah, the material stresses just multiply. You need aerospace-grade subsystem integration, you need custom tooling, rigorous fatigue testing. All of that requires an exponential leap in engineering costs.
So that $13.2 million is effectively buying the physical reality of the X7. It's the cost of moving from a theoretical model to a multi-ton vehicle that can actually carry human beings.
Precisely. And they are targeting the first quarter of calendar 2027 to begin initial testing of this full-scale prototype. Hitting that Q1 2027 milestone means procuring specialized components today.
Because aviation lead times are awful.
Incredibly long. Yeah.
Yeah.
So the cash has to be deployed aggressively right now just to secure a spot in the production queue for critical parts.
And because that cash burn is so highly visible to retail investors, management is, they're highly motivated to soothe the market. They have to prove they aren't trying to reinvent the wheel in-house.
Right. They need to show they aren't blowing cash on things other companies have already perfected.
Exactly. In the earnings release, CEO Brandon Robinson called this a transformational period, moving from tech validation to full-scale development. He leaned heavy into their strong balance sheet and increasing strategic partnerships. He even dropped the quote, "I couldn't be happier about the future."
Well, I mean, that's standard executive optimism during a high burn phase. The market demands confidence when the revenue line is a zero.
Oh, for sure.
But the actual strategy behind that optimism, the partnerships, is where the real mechanical analysis lies.
Yeah, let's break down those partnerships because they are making some massive bets on third-party suppliers. They are partnering with Beta Technologies to source advanced fly-by-wire flight control computers.
Which is huge.
Yeah, and they brought on RAMPF Composite Solutions to build the main fuselage and the empennage structures. Plus, they contracted North Aircraft Industries to manufacture their patented HOVR wing architecture.
We should probably translate some of that aviation jargon for the listeners.
Good call. So the fly-by-wire system replaces manual flight controls with an electronic interface. The fuselage is just the main body of the aircraft, and the empennage is the entire tail assembly.
Perfect.
But honestly, I question the CEO's glowing optimism regarding these outsourcing deals. Are these third-party partnerships genuinely de-risking the timeline, or do they just introduce a labyrinth of supply chain vulnerabilities? I mean, Horizon basically isn't in control of its own manufacturing destiny at this point.
What's fascinating here is the aggressive trade-off inherent in an asset-light manufacturing strategy. By outsourcing the composite fuselage to RAMPF and the flight controls to Beta, Horizon is actively choosing to keep their CapEx, their capital expenditures, vastly lower than legacy aviation giants.
Right, because traditional OEMs build a multi-billion-dollar factory before they even have a certified plane.
Exactly. They vertically integrate everything. Horizon is leveraging an established, heavily capitalized supply chain to keep their own overhead low.
So they avoid sinking, $50 million into a composite curing facility just to build the body of the plane.
Yeah, they dodge the infrastructure trap entirely. Curing advanced carbon fiber requires massive industrial autoclaves. By letting RPF handle it, Horizon preserves a huge chunk of that $78.3 million in cash.
But there is a flip side to that coin.
There is. Your skepticism is entirely validated by the 10K itself. When you strip away the sunny PR quotes and read the risk factors, they explicitly note they are entirely dependent on these specific third-party suppliers.
Yep. If Beta or RAMPF run into a sudden liquidity crisis, a labor strike, or even just a manufacturing bottleneck, Horizon's Q1 2027 testing timeline completely evaporates.
The bottleneck just moves from their own bank account to someone else's loading dock.
The 10K even mentions a scenario where Horizon might have to provide substantial financial support to those suppliers just to ensure their own parts get finished. You are essentially trading financial risk on your balance sheet for severe operational risk downstream.
And let's not forget, integrating parts from 3 different specialized manufacturers into a radically new aerodynamic design is a monumental engineering feat all on its own.
Which brings us to the human capital side of things. Sourcing the parts is only chapter 1. Getting them to talk to each other and convincing the federal government that the aircraft won't fall out of the sky requires intense human capital.
It really does.
This quarter, they announced the appointment of Richard Alexander as Chief Engineer of Certified Programs. Management also projected their headcount is going to nearly double, scaling from 56 employees today to over 100 by the summer of 2027.
That doubling of headcount, that's just the sheer human cost of moving from a prototype to a certified commercial aircraft. You aren't just hiring people to turn wrenches anymore.
Right, you're hiring people to write endless compliance manuals.
Exactly.
I look at the hiring of a chief engineer of certified programs as being a lot like hiring a highly specialized translator. You need someone who can speak the deeply technical language of engineering, but who is also perfectly fluent in the bureaucratic language of the TCCA in Canada and the FAA in the US.
Because the regulatory bottleneck is the single greatest existential threat to any eVTOL company, bar none.
Oh, absolutely.
You can engineer the most beautiful, efficient aircraft in history, but if the FAA refuses to certify your flight control software, you've just built a very expensive museum piece.
And the technology Horizon is trying to push through that regulatory maze is wildly unique compared to the rest of the sector. The Cavorite X7 uses this patented HOVR wing system.
Yeah, it's a huge departure from the norm.
If you look at competitors, they almost all rely on multiple open rotors, like a giant quadcopter, for vertical lift and forward thrust. Horizon goes a completely different route. They hide their ducted lift fans entirely inside the wing structure.
Right.
For vertical takeoff, covers on the wing slide open, the fans spin up, and the aircraft rises. But once it hits a certain altitude, those covers slide shut. Then the aircraft relies on a traditional rear propeller for forward thrust, basically flying like a highly aerodynamic standard airplane.
And the mechanics of that design choice are directly tied to their certification strategy,
Yeah.
specifically regarding severe weather operations.
To FIKE certification.
Exactly.
Huh.
The 10K details a relentless pursuit of FIKE flight into known icing. Let's look at the physics of why this is such a massive differentiator. When an aircraft flies through freezing moisture, ice rapidly accumulates on leading edges, right?
Right.
For an open-rotor eVTOL, ice buildup on a spinning propeller blade completely alters its aerodynamic shape. It destroys the lift profile, creates violent mechanical imbalances, and can cause cascading catastrophic failures.
So an open rotor essentially becomes an unguided ice thrower, or it just shakes itself to pieces.
Pretty much, yeah. The physics dictate that an exposed rotor is fundamentally vulnerable to freezing precipitation. By sealing their vertical lift fans inside a protected wing cavity during forward flight, Horizon avoids the icing problem on their most sensitive components.
That's incredibly smart.
It is. They rely on that single, partially protected rear propeller for forward flight, which can be equipped with traditional, well-understood heating and de-icing mechanisms. That makes FIKE certification a mathematically realistic goal rather than an engineering pipe dream.
And the operational advantage of FIKE for a commercial airline buyer cannot be overstated. You can't run a profitable regional air taxi service if your fleet is legally grounded by the FAA every time there's sleet in Chicago in November.
Exactly. Fair weather aircraft do not make money for airlines.
But as sound as the commercial logic is, the certification timeline is still agonizingly slow. Even with a brilliant design and a former regulatory insider acting as a translator, commercial certification takes years.
Yeah, Horizon isn't projecting commercial passenger production until 2028 or 2029 at the absolute earliest.
Which creates a massive dead zone.
Right. That dead zone between prototype and passenger flights is why their dual-use strategy is structurally vital to their survival. The 10K outlines they are aggressively targeting both civilian and military applications simultaneously.
Now, you might be listening to this thinking, why is a commercial air taxi company suddenly pivoting to talk about military sales? It can sound like a desperate attempt to find a buyer, any buyer, but there's a brilliant regulatory loophole at play here, isn't there?
There is. Aircraft procured for military operations or special defense missions, well, they don't have to wait for the same commercial PCCA or FAA civilian certifications. The military has its own internal airworthiness evaluation processes.
Ah, okay.
So by pursuing a dual-use model, Horizon is actively trying to generate defense sales years before the commercial passenger certification grinds through the civilian bureaucracy.
It's an early revenue lifeline.
Exactly. It bridges that financial gap between building the prototype in 2027 and flying civilian passengers in 2029.
And that lifeline is vital because the company still has to survive long enough financially to see those defense contracts materialize. Which brings us to a fascinating discrepancy in the filings.
Oh, this is the best part.
We have to look at the massive gap between the flashy public press release and the incredibly sober reality of the SEC filings.
The juxtaposition between a PR team's narrative and an auditor's strict legal requirement always reveals the true financial tension.
Totally. So in the earnings press release, management loudly highlights their $78.3 million in cash. They explicitly tout that this war chest provides more than 24 months of liquidity. It paints a picture of ultimate financial security heading into the prototype phase.
Sure does.
But when you open the actual 10K and navigate to the going concern note, the tone shifts dramatically. The 10K states management expects sufficient funds for at least the next 12 months, but it explicitly cites substantial doubt regarding the company's ability to continue as a going concern beyond that 12-month window without securing additional capital.
Right.
Here's where it gets really interesting. How should a retail investor square these two contradictory statements? Is management just being overly aggressive in their press release to prop up the stock price, or is there structural accounting reason for this discrepancy?
If we connect this to the bigger picture, you are seeing a collision between strict GAAP accounting rules and internal operational forecasting.
Okay, walk us through that.
So, under generally accepted accounting principles, GAAP auditors are forced to look at a company's current cash balance against a rigid, worst-case projected burn rate over a strict 12-month window. Because Horizon is pre-revenue and their cash burn is guaranteed to accelerate as they buy parts and hire engineers, the accounting rules offer zero flexibility.
So the auditor's hands are tied.
Exactly. The auditors are legally required to issue a substantial doubt warning for any period beyond 12 months. They aren't forecasting doom, they're just mathematically projecting the current burn rate forward without assuming any unproven windfalls.
Meanwhile, management is using a dynamic operational forecast.
Right. Management is calculating their ability to throttle spending if necessary, and they're factoring in potential inbound capital that the auditors just aren't allowed to count yet.
Like government grants. The 10K heavily details a Canadian government initiative where Horizon expects a significant chunk of their project costs to be reimbursed.
Yeah, management genuinely believes that between cost controls and federal aerospace grants, they can stretch that $78.3 million out for a full 24 months.
But as an investor, you have to prioritize the 10K reality. No matter how well they manage the cash, the runway eventually ends before commercialization.
Always does.
And we already have hard proof of exactly how they plan to refill the coffers when that runway gets short. We need to dissect their ATM, their at-the-market program.
Yeah, let's talk about the dilution.
During fiscal 2026, Horizon sold over 9 million Class A ordinary shares into the open market, raising roughly $27.9 million. And they recently filed a prospectus to adjust their ATM capacity, allowing for up to $28 million in future share sales.
So, for anyone unfamiliar with the mechanics, an at-the-market program allows a company to trickle newly issued shares into the open market dynamically, usually on days with high trading volume.
Rather than doing a massive secondary offering.
Right. It's often preferred because you avoid selling a massive block of shares all at once at a steep discount to institutional buyers. It's a highly efficient way for a pre-revenue company to raise cash incrementally.
It's efficient for the balance sheet, but it is the ultimate double-edged sword for early-stage aerospace investors. I mean, on one hand, you desperately want the company to survive. Selling equity is literally how they funded that massive R&D jump we talked about.
Without that $27.9 million from the ATM, the Q1 2027 testing timeline would just be fiction.
Absolutely. The trade-off, though, is the mathematical certainty of dilution for the retail investor. By continuously expanding the total share count, every existing share you hold represents a marginally smaller percentage of the overall company.
And the 10K doesn't hide this.
Yes.
It explicitly warns that future capital requirements will likely compel them to sell additional equity. Given that commercial production is slated for 2029 at best, and the ATM is primed for another $28 million, the company will inevitably tap the equity markets again.
The $78.3 million is a fantastic buffer today. But the dilution risk over the next 3 years isn't just a possibility.
No, it is a structural guarantee. It is the brutal cost of admission for getting in on the ground floor of a pre-revenue hardware company. You are directly funding the sheer climb up the development curve.
Okay, let's synthesize all of this so you can walk away with a clear picture. Horizon Aircraft has a solid $78.3 million in the bank to fund their immediate future. They have designed a clear asset-light roadmap utilizing specialized partners like Beta and RAMPF to avoid building massive factories.
Which allows them to sprint toward getting that full-scale Cavorite X7 prototype in the air by Q1 2027.
Right. However, the clock is absolutely ticking. The cash burn is accelerating by necessity. Massive regulatory hurdles with the FAA and PCCA dictate the timeline, and retail investors face the undeniable reality of future dilution to keep the aerospace dream funded.
The entire thesis rests on a race between hitting engineering milestones before the balance sheet forces their hand.
So what does this all mean? I want to leave you with a final, slightly provocative thought to mull over, based on a very subtle detail buried deep in the business strategy section of the 10K.
The IP licensing.
Yes. Management briefly notes that in addition to eventually selling physical aircraft, they believe their patented fan and wing technology might create lucrative future licensing opportunities with other original equipment manufacturers. Think about the implications of that for a second.
It changes the entire valuation model.
It really does. What if Horizon's ultimate financial victory isn't actually in successfully manufacturing thousands of Cavorite X7s themselves? What if their true billion-dollar value is simply licensing that aerodynamically efficient, FECI-capable HOVR wing IP to legacy aerospace giants?
Because you have massive incumbent companies with billions in capital and established global factories, but they are desperate to enter the VTOL space without starting their own R&D from scratch.
Exactly. If that 2027 prototype proves the physics work perfectly at full scale, Horizon might never need to build the massive factory. They might just need to sell the blueprint to the highest bidder. Follow the show for your daily dose of tight, no-nonsense earnings coverage.